Okay, good morning to everybody. Today is the 25th of November, and just going to give you a bit of an update as to where we are in the section. We're getting very close to the end of the term. We only have 13 and 18 as chapters yet to cover, so we're getting very close to the end. We talk about chapter 13 here. The Smart Book quiz is going to be due on the 28th, which I know is a couple days after or the day after Thanksgiving, which I'm sorry, that's kind of the way I can't control the calendar. So it's good. We're kind of getting toward the end here. And then the homework and the ethics case are going to be due on 11:30. And I mentioned in the class, I did want to talk a bit about the ethics case and talk about what's going on. A couple of people have already submitted it, and so that's good. But I do want to kind of go to the ethics case in the website here. So let's kind of take just a second here and talking about what's going on. So it's actually under the week 12 module, and I made that available a little bit earlier than normal. And the due date is November 30th. I know there's some language inside the assignment itself. It says 11:23, but it's 11:30, which is this Sunday. So what you're doing here is you have your choice of 5 cases in the textbook itself that you're going to look at as far as an ethics case example. Now, why are we doing this? Well, primarily what's going on here is sort of there's a bigger sort of motivation. And the backdrop of all this is the fact that the accounting industry really was sort of rocked to its core in the early 2000s by some real scandals about financial accounting and auditing and sort of lax standards and whatnot. So ethics became really more of an emphasis, and it's never been de-emphasized. I don't want to suggest that, but there were some firms that were, frankly, playing it fast and loose with allowing their clients to do things which, in terms of reporting, that was not really kosher. And so, as a result, we had some new laws passed, notably in 2002, the Sarbanes-Oxley Act, which we simply refer to as SOX or Sarbox, whatever you prefer. And so, ethics became a really much more important piece of the puzzle. In fact, our business school accounting accrediting bodies are really emphasizing the fact that we talk about ethics in our accounting courses. And so this is really a big issue. It sort of supersedes some of the other more technical concepts we're covering in terms of journal entries and statement prep and all that. So this is why the emphasis on ethics. So you get your choice of these, and for the ethics case, you're going to comment on each of the 7 steps of the analytical model for ethical decisions. It's in chapter 1, so hopefully you've already read that, but I'll go back. I think it's illustration, I think it's a 1.9. Yeah, illustration 1.9. And this is the framework for resolving an ethical dilemma. So you're just basically going to apply this framework to the problem at hand and say, okay, answer these questions. And I don't know that I would get too in depth, but don't go too briefly. But I wouldn't go page over page over page. This is not intended to be a 20-page paper or anything remotely like that. So, but it is important because we are addressing the issue of ethical conflicts that arise in the workplace, and these come up all the time. I can tell you from personal experience, there are always ethical issues that come up, and it's not always obvious as to what to do. And so, from an accounting standpoint, we can apply some of these steps in this framework. And again, a framework is sort of a way of organizing our thoughts as to what to do, and then our actions sort of derive from this particular framework. So you're going to apply that to this particular problem in hand. By the way, I'll say it in case I forget here. I don't know that you need a lot of citations in terms of footnotes or whatever. I mean, in business schools we tend to use the APA style with we have in-text citations and references, but although there are other styles out there like footnotes and notes page and whatnot. I don't think you have to use any of that, really. I don't think it's really necessary. I think you can just sort of apply your own logic to this. Most students do very well, so I would not stress about this unless you're sort of missing the pieces, the elements that are required. My belief is that in training accountants, what we're trying to do is to make sure you sort of follow the steps that are given and follow instructions. It's a big part of what accounting is, and follow step by step. And so I think if you do that, you'll probably be okay. As long as your presentation is logical. So that goes to that piece there, and then you'll submit it. And I don't really care about how you submit it in terms of the format, in terms of how you say it and whatnot. And again, the due date is November 30th and so not November 23rd. I could not edit it for whatever reason. And this course was copied into this particular semester, and I could not change the due date. But it's not November 30th. I'm sorry, it's not November 23rd, which is obviously already passed. It's November 30th, which is this Sunday. So you've got some time to do it. In terms of page count, word count, students sometimes ask about this. I don't know that that's really that critical here. I think it's more the ability to be concise and to discuss what's going on. And again, I think outside research is not necessarily needed here. This is not a term paper. It's not a capstone project by any means, but it is one that sort of emphasizes the ethical issues that are facing accountants today. And there's more scrutiny placed on the accounting profession now than what there was. I mean, there's a new, governmental or sort of quasi-governmental body called the PCAOB, Public Company Accounting Oversight Board, which did not exist prior to 2002 and Sarbanes-Oxley. And so the industry, the accounting industry, which mostly was self-regulating, is a little bit less self-regulating. But hopefully, as we enter into this new generation of accountants, things will become a little bit more ethical and whatnot. So, and I don't mean to draw a broad brush whatsoever across the industry. It's just the fact that there were some major players that did majorly bad things, and so as a result, there was a new law passed. If there weren't bad things, there would not have been Congress and president acting on these kind of things. And so, as a result, this is what happened. So, all right, so that's the ethics case, and then obviously the rest of the work for this particular week is pretty self-explanatory. But if you have questions, feel free to get with me. I'm more than glad to help you out with that. Okay. All right, so let's go. We left off, we're talking about chapter 13 here. And again, as I mentioned some time ago, that we're sort of covering what a lot of intermediate accounting really is sort of an exposition of some of the methods and applications that are used to treat certain accounting issues that come up, whether it's things like depreciation or amortization of certain things and whatnot. And but it's also sort of in a more broadly construed context. It's sort of a walk around the financial statements, and so this is what we're sort of doing. We did that all the way down the left side or the asset side of the balance sheet, and we're going to do it on the right side. And so intermediate 1, which is this course, obviously stops there. And for those of you who go into intermediate 2, you're going to go into other areas as well, but just kind of know that's sort of the logic of how intermediate accounting is sort of organized. And it's not considered one of the easier courses, frankly. And if you're finding yourself spending more time on this course than others, that's probably correct. I don't think anybody's ever sugarcoated the meaning of what intermediate accounting is. It's considered to be challenging, and it's intended to be. It's also intended to be the course that prepares people to take the CPA exam. Much of the content of which sort of flows out of this, and not all, but a lot of the content flows out of this, and so that's what's going on. So, all right, so we're in chapter 13. We're talking about this issue of liabilities, and we're in current liabilities right now. And so we talked a bit about notes payable, we talked about accounts payable and whatnot, and now we're going to talk about compensation of employees. One of the things that I think is, I sort of disagree with the textbook a little bit, because I would sort of move up in terms of priority on the right side of the balance sheet. On the liability side is the things like employee compensation, which, I mean, this is due fairly currently, right? I mean, workers can't work on credit. You can't ask workers to wait for 9 months or 6 months or whatever to be paid. And so as a result, worker compensation becomes a payable, but in the intervening period between cutoff periods, statement cutoff periods, usually it's simply debit to salaries and expense, credit to cash, right? But it's not just that. I mean that would be pretty easy if that were it. Instead, there are all kinds of other things, and there are accrued liabilities that come up, and so this is where it becomes a little more complicated, which is why we have HR departments, and HR is becoming sort of a thing in its own right, to sort of rival the traditional 3, main focus areas of production or operations, finance, and marketing, right? So HR is an important issue because there are a lot of these things that come up, including things like accrued wages and whatnot, but also absence and the idea that you could have a benefit if you have paid days off. Certainly, I know that here we have sick days and whatnot. So if I don't take the sick days here pretty much expire. But a lot of places they sort of roll over, and you can accrue hundreds of hours, hundreds of days of sick days. And so if you have a heart attack or break your leg skiing or whatever, you have the opportunity to sort of pick that up. But the idea is there's a liability, and that's really the key issue from the accounting standpoint. Is there's a liability created on the part of the employer slash the payer in this case. And so the paid absence can be taken in a later year, and it can accrue over time. And so, and the conditions of these paid absences are, it's going to be, it's already performed, so it's done. So we have an accrual. Remember, the accrual is the case where the work has already been done, the service has already been provided, whatever. And so the cash is yet to be provided. That's the very definition of accrual. And payment is probable. We talked about this. Payment is probable that it's likely to be paid, and we can reasonably estimate what that amount is going to be. So those are sort of the conditions by which we sort of accrue these liabilities in the sense of that. And there are some other liabilities as well, things like sick days and personal days. A lot of companies and organizations generally have personal days where you take a day off for whatever reason. You have a funeral to go to. You have an event, a wedding, a bar mitzvah, whatever it is. You gotta leave town, and as a result, there are some days off. And so as a result, all these are absences. We sort of treat sick days a little bit differently than we do personal days, but nonetheless, the idea is roughly the same in terms of the accounting. And so in this regard, here's an example. Davidson Getty Chemicals has 8,000 employees. Each employee earns 2 weeks of paid vacation per year. Okay. Vacation time not taken can be carried over to subsequent years. So during the year in question, 2021, 2,500 employees took both weeks vacation, right? So which means the majority did not take that, right? So at the end of the year, 5,500 employees had vacation time carriers. I don't know how realistic of a scenario this is, but 5,500 employees not taking their vacation. But let's just kind of go with the scenario. So in this case, we have no obligation going forward because for the first 2,500 because they've taken it. So there's no liability. However, there are 2,000 people who have taken earned 1 week but not taken them. So there's 2,000 hours, and we're assuming again the wage rate and all that. So we would drill down into this and accrue actual wages. And then the other 3,500 of that 5,500 had 2 weeks left. And that's as unrealistic as that is, nonetheless, we have 9,000 care weeks. And we're going to say average compensation was $600 per week per employee. So $600 a week times this number of 9,000 is going to give us an amount carried, which is going to be $5,400,000. So what's the journal entry here? Well, let's go back to what the journal entry is actually. So first of all, we have people who are taking their vacation, 2,500 workers, and they're going to take them, and we're going to sort of debit salaries expense and credit cash. Okay, they're not working, but it's a benefit that they're entitled to, and so they're going to take it. And a lot of full-time employees have vacation time. And sometimes this is separated differently than other wages and whatnot, but salaries and expenses is sort of a large catch-all category here. So we're going to debit that $4.2 million for that, and then we have an adjusting entry for the salaries and expense that is not incurred. Now we're going to record the expense here because we have incurred it in the period in which it was happening. Right? This is the logic of accrual accounting. Yes, we know we have an expense. We haven't paid it yet, so therefore there's no credit to cash. Instead, there's a credit to liability, compensated future absences, and that's the idea that people have time coming, and we're going to have to pay them for it, and it's not going to be matched at all with their particular particular service. But the idea is, though, that we're going to sort of accrue the expense now, record it, and we have a liability at this point. Okay, so that's essentially what's going on there, and we can do this for personal days, sick days, whatever the case might be. And a lot of firms, or I say firms like like it's the only employer, but any kind of employer, whether it's private sector, public sector, a lot of times offer sick days and whatnot to workers. And a lot of workers take advantage of them, some do not. And as a result, and sometimes they carry over into future periods, and sometimes they do not. So it really depends upon the policy of the employer as to how to treat those. But given the policy, this is the accounting framework that we've established for how to deal with them. So we create a liability for unused compensation. And the compensation is simply paid compensation for them not working because they're granted that as part of their employee benefits package. Okay. Okay, and then as we go forward here, we have compensated future absences, and so this result at some point we're using more of those, and so as we use them, we're sort of debiting cash or crediting cash as a result of that because we're paying those workers for whatever it is that they are eventually pulling forward. Okay. Okay, talk about bonuses, and so this is an area where, and again, a lot of these are current liabilities. Remember, we're still in current liabilities here in Chapter 13, and we'll get more to the longer term aspects of Chapter 13. Hopefully tomorrow I'll have the opportunity to record more on this. But we talk about bonuses. What are bonuses? They're usually tied to performance based upon things like whatever it is, revenue, profits, earnings per share, number of customers, sales, whatever the case might be. Number of compensation schemes out there are practically limitless, and so bonuses are usually tied to that. Not all employees get bonuses, although there's been a sort of a trend, I think, in the business world the last, I don't know, maybe 30, 40 years to sort of expand this pool of people who are able to get bonuses. The feeling is on the part of management that it sort of incentivizes people to work harder and do more if they can get a little bit of a taste, if you like. I think traditionally, at least certainly when I was an undergraduate, a lot of bonuses were considered executive bonuses, the top tier of management, although it's been expanded. And certainly, even our textbook talks about the idea of executives getting it. Certainly, the executives are getting it at the lower levels of the organization are getting it. Certainly, the executives are. But I just want to make the point that it's sort of being expanded, in some areas, not in every organization, because we're talking about all kinds of different organizations out there, so it's hard to draw a broad brush about it across it. But the point is, though, I think that we can make a very strong case that bonuses have been expanded downward over the years in the public, in the private sector in particular. So what it really represents is a compensation expense in the period in which they're earned. And so what are the common measures here? Some are purely financial, EPS, earnings per share, net income, operating income, and whatnot. But what is probably more important, and we talk a bit about this in Accounting 2110, is the idea of some of these non-financial measures, things like customer satisfaction and retention of customers and expansion of new markets and how we're penetrating new markets and all that sort of thing. And the list of the elements of this can go on and on and on. And we call it a scorecard. And in fact, scorecards have been used for quite a long time. Certainly when I was in management, we used management scorecards to say, okay, you're going to be assessed on these areas. Some of these are numerical or financial, dollar-based measures, and some are not. Some are going to be based upon customer satisfaction, or even things like employee turnover, employee satisfaction. There are a lot of managers out there who don't particularly do well with employees, for instance. And as a result, this is kind of a measure. And so you might be wondering, are we getting off the track here of accounting? And not really, because the bonuses are going to be based upon this particular methodology that the individual firm uses. And this is not a human resources class. And if you really want more detail on this, HR courses really get more and drill down deeper into this. What we're really interested in is how we do the accounting treatment. So we're saying there's earned bonuses to people, and again, the textbook sort of refers to it as executives, but it could be anybody within the organization who's able to get it. So all this is really an example of a current liability, and we're treating it as a current liability. And oftentimes they're paid sometimes toward the end of the year, frankly, a lot of times before Christmas, and they usually appear as current liabilities and they go away as current liabilities because they're paid and they're simply an expense and whatnot. So my experience having been in management is the idea that bonuses sort of accrue, and as of, I don't know, maybe January or November 30th or whatnot, and we're paid sometimes before Christmas, and that's kind of it, and it kind of disappears. And so remember, current liabilities show up and they go away, and that's kind of the way these things happen. Okay. All right, so any questions, anybody in the room here or on the Zoom call? Okay. All right, so we talked a bit about bonuses. Let's talk about now we're still talking about current liabilities, and we're going to sort of shift gears here and talk about liabilities that arise from advance payments. Okay, so customers sometimes pay in advance for things, whether it's deposits, whether it's prepayment in full for whatever it is, whatever the case might be. But these are always created as liabilities, and so we debit cash, we create some, and we credit some liability, whether it's unearned revenue or deposits, whatever we want to call it. Remember, a credit balance account is a liability, I should say a liability is a credit balance account. So in this case, we're talking about advance collection, and whatever those might be. And so deposits are one thing. So probably the one thing that's easiest to understand is things like a deposit on a piece of machine you rent from somewhere, right? Sometimes you rent a car and they want a deposit from you. You can rent an apartment and they require a deposit from you. And that's simply to cover any future liability that the seller may have, supply side actor may have here. And so as a result, it's created as an asset on the buyer's side, but a liability on the seller's side. Remember, there's always a balance between balance sheet accounts. The entire economy is based upon balancing debits and credits all the way across the economy. So in this case, there's an advance collection for whatever. And sometimes these are refundable, and sometimes if it's a deposit, and sometimes these are advanced and simply based upon I'm paying you ahead of time for something that you're going to provide later. And the examples just go on and on, right? You buy tickets on a cruise ship, you're paying this ahead of time, right? Because they want to know how many people are going to be on the cruise ship from Miami to wherever, right? And so as a result, that's going to be an advance that's going to be recorded as a liability. And we're going to get to the journal entries here in a second. That's an example. Refundable deposits are simply those things where we have to put money down as a buyer, and we're going to get it back, presumably we perform all of our obligations and whatnot. Okay, so that's deposits and advances, all of which are current liabilities, credit balance accounts on the liability side. Let's talk a bit about gift cards. Gift cards are interesting, and I don't know about you, but I've got like a stack. It's like a 5-inch stack of gift cards that have been accumulated over the years, and so these are simply accrued liabilities that companies have. In other words, they sell the gift cards, they debit cash, they have a liability for gift card liability, and at some point they may decide, hey, these are never going to be redeemed or whatever. And I'm a little bit concerned because I've got a bunch of Starbucks and Applebee's and gosh, who knows, gift cards that I've never redeemed, and supposedly they never expire. But at some point, firms say they're never going to come back because they've been lost on a couch or burned up or whatever. Who knows, whatever the case might be. But those are examples that it's very analogous to the deposit. We're putting money down now, and a lot of these are given in the form of gifts, right? I'm giving you a $50 gift card, right, to Applebee's, and so as a result, let's have Applebee's, debits cash and credits current liabilities, right? Current liabilities being gift card. And when the whole thing comes in, somebody redeems the cash, we simply debit the gift card and we credit revenue. But we don't recognize revenue. Again, I say we on the seller's point of view here, we don't recognize revenue until the whole thing comes in. But we do recognize it when we determine that it's never, ever, ever, ever going to be redeemed. And what's really interesting, there was a great story that came out about 6 or 8 months ago about TGI Fridays. I may have talked about it here or in another course, I don't recall, but TGI Fridays is in bankruptcy, and a lot of their franchise holders wonder what to do about whether they would get paid if they honored the gift cards, because there are all these gift cards floating around. I mean, I don't know if you're like me, but I've got too many of these, and I probably should redeem these at some point. But it's like I've got like a whole stack, like a deck of cards I got to redeem and whatnot. So are they good? Who knows, right? But if the company's in bankruptcy, what happens? And so the franchisees, which are the owners of local operations, are wondering: should we redeem these? Should we refuse these? What is the step to take? So maybe this has all been worked out by now, but I thought it was a very interesting story, one of those business case studies in which we can examine what happens when gift cards become potentially not as bad as what we think they are. And then collections for third parties. When we talk about collections for third parties, what we're really talking about here is the idea of primarily payroll withholding from workers, but it's not just that. I mean, we could do a whole day, I think, talking about collections for third parties, but primarily what we're talking about is the idea we're creating a current liability for things that we have to forward on to other parties, like sales tax, for instance. That's a big one. If you sell a product, remember, we're on the supply side of the market. That's primarily where we are. So we're selling a product that's subject to sales tax, and so a good that costs $1 is $1.08 or whatever, right? Or $1.09, depends upon the sales rate, and where we are. In Bernalillo County, I think it's 7.875%. So we collect the tax, right? The tax is not ours to keep. We have to create a liability, right? We collect the cash, we debit cash. We also have to credit the portion that differs from the sales amount, which is $1, to a current liability because we have to forward it on to someone else. And it's not just sales tax, it's also income tax that we withhold for our employees, both state and federal. Unemployment tax, if there's an unemployment tax levied on workers, and in some states there is a levy on workers, some states there's not. Workers' comp, unemployment taxes, things like medical insurance, health insurance, dental insurance, vision. I mean, the list goes on and on. Things that we create as a current liability that we're going to forward on. We, the employer / producer here, are going to forward on to somebody else, right? We're withholding it from it. Now, it's not going to be in our current liability for very long. That's why it's a current liability. It's not going to be there very long. We're going to, at some point, forward that on. And when it comes to things like sales taxes and income taxes, usually it's payable on a quarterly basis. And if you've got an accounting staff that knows what they're doing, it's no big deal. They'll simply forward it on and on a quarterly basis. And or if it's health insurance, maybe more of a monthly basis, but it's fairly straightforward. Okay. All right. Any questions so far? Okay, let's talk about deposits. We talked a bit about that earlier. We sort of broke into the broader scheme of what's going on here. So here's an example where we have Ranker Chemical Company sells whatever it is, inexpensive reusable containers. Okay, so they want them back, and the only way to get them back and ensure they get them back is to charge a deposit. And the fact the deposit amount exceeds the actual fair market of the goods themselves, and that sort of ensures that they're going to get them back. So customers are charged a deposit for each container delivered and receive a refund when the container is returned, okay, in good order. So deposits collected during the year were $300,000. Deposits are forfeited, the containers are not returned within 1 year, and 90% were returned within the allotted time. So 10% are not, for whatever reason. Right? So, and deposits charged are twice the actual cost. So twice the presumable fair market value. And so that sort of is an encouragement for the buyers of whatever this product is, chemicals, to return those things to get the deposits back. Now, in reality, what happens is they probably return them and the deposit just simply rolls over and over and over. But the initial entry is this. So $300,000 is collected cash, and there's a liability refundable deposits, right? Now, if every single customer returned every single item, then it would simply be, we reverse the transaction, where simply we give the cash back, we have a credit, and a liability goes to a debit. So that's how we zero out the liability. Okay, but that's not what always is the case. Sometimes they're all returned, sometimes they're not. So in this case, 90% are returned and 90% and 10% are not. So the liability, we've reduced the balance here with liability, and we give back $270,000, which is 90% of the $300,000 we collected. Easy peasy, no big deal. You brought it back, it's in good shape. Okay, fine, whatever. And so we reverse the transaction. And these are all aggregate entries. This is not one journal entry. These are a collection of entries over however much time is being covered here. But the idea is that we're going to give back $270,000 of the $300,000 we collected. However, there's $30,000 that did not come back. And so, and maybe there's time frames where you got to bring it back within X number of days or whatever. And so as a result, if you forfeit it, well, you forfeit your money. And so as a result, we simply reverse the liability and we just simply credit to revenue. This is our revenue. And so remember, it's greater than the amount of the cost of the goods themselves. The cost of goods was half of what those goods sold for or were charged for. So as a result, we actually have made money on the the forfeiture of bringing back those goods, because we've charged a premium price for the deposit itself, which again serves as an incentive. I don't know a lot of sellers that really want to make revenue in this regard. Maybe I'm wrong or naive or whatever, but the idea is that if in fact people don't bring things back, they're going to be paying more for those goods than what they could pay at a fair market value price. And so as a result, the company has booked revenue, which is in fact what it is, right? They've sold that good. Now, by the way, they're selling chemicals, not chemical containers. But as a result, what do you do with it? Where does the credit balance go? It's got to be to revenue. I don't know where else it can go, right? So we credit revenue for 30,000, but we also take these off the books because these are no longer in our possession. So if they're no longer under our control, right? An asset is something that's owned or controlled. If it's no longer owned or controlled by us, we have to take it off our books. And how we do it, we're simply creating a sale here. We have revenue, we also have cost of goods sold, and we're going to simply create a debit to CGS and inventory as a credit. And so that's the way we get that off our books, right? And I suppose there's recovery possible if the company allows it sometime down the road, but in this scenario, we're not really assuming that's the case. So it is the case. Sometimes people don't bring things back, and that's a problem, right? And so anybody who sells goods subject to this have got to know this is an issue. Okay. All right. We talk about advances, and again, we're sort of going back to the sort of this master slide we looked at earlier. We say these are the different examples of current liabilities that may arise to a firm, which do not include things like accounts payable and notes payable, but are nonetheless current liabilities that we have to treat and report. And so in this case, these are liabilities of the product and services provided, and these are advances. And this is where we get into things like gift certificates, subscriptions, layaways, tickets. I mean, the list of this goes on and on, right? We buy things in advance. So if you're the buyer, right, you buy things in advance. And so what is the transaction on the seller side? They debit cash and they credit a current liability, right? And when the service or good is provided, they simply debit that liability because it goes away, and they credit revenue. They don't credit revenue until the good or service is provided. That's what accrual accounting is based upon. So only when they provided that. And one of the examples that a lot of textbook authors use, because a lot of them university professors, is they have season tickets to football games or basketball or whatever, right? Where you collect them out front, and as every game is provided, I guess, or we sort of we debit the liability and we credit revenue for that one particular game, because now we have earned it because it's been provided, and that's what people have been paying for. Is that particular service. And so these are examples of advances from customers. And examples of this go all over the place. I mean, we often pay for things like cruise tickets, airline tickets, hotel reservations. It's practically impossible. I mean, I've done my share of traveling, mostly business travel in my life, and I just can't imagine not staying in a place that I've not reserved ahead of time, at least a couple of days or whenever I know that I'm going to be traveling. And so from the standpoint of the hotel or whatever, it's going to be debit cash, credit liability, right? Current liability. And when I stay, I stay there, they simply debit the liability and credit revenue. And that's the way that they sort of zero that out. So there are lots and lots and lots of transactions that go away. Layaway is interesting. I mean, I think for a lot of us, layaway was sort of an interesting thing that almost disappeared from the retail space. In fact, I think a lot of people don't really know what layaway is. Layaway is simply a case in which people pay for a good, but they'll actually move the physical good out to the sort of a back room or whatever until you pay it off. And so you're going to buy it's usually fairly big ticket items. It's not something like, Pop-Tarts or shampoo or whatever. It's usually something like, a piece of furniture or whatever. And so people will pay on it and the firm will move it away. But that's not really the accounting. The inventory piece is not really the accounting transaction up front. What is up front is the fact they collect the same issue here: debit cash, credit account, current liability. And when they paid off that particular ticket, then okay, here's the good. Here's the recliner or whatever it is you want. So as a result, that's a layaway. And I don't know if I think Walmart did or does layaway. I don't really know. But layaway used to be a much bigger thing prior to credit cards in particular, right? A lot of people have credit cards now, they can pay with that, which is maybe not as advantageous because I don't know that there was an interest expense built into the layaway, but nonetheless, that was as an example of that. Usually on a retail basis, business to consumer, where customers simply don't have the cash to pay the good at the present time. They want to lock it in. They want to make sure they have access to that good when they're able to pay for it. Okay. All right. So, but these are all examples of current liabilities that the seller is going to establish as a credit account on the liability side. They're going to collect cash, and ultimately that transaction will be closed out, hopefully within a year, or the accounting cycle, or the operating cycle, whichever's last. Okay. All right. So in this case, another example is subscriptions, and we talk a lot about subscriptions. And so you got, in this case, Tomorrow Publications collects magazine subscriptions, and so $20 million is collected in cash, debit cash, and deferred revenue. So remember, this is a deferral. Deferred revenue is a liability, right? In this case, a current liability. We've collected cash for something we haven't yet delivered. We're going to be delivering within the year or the operating cycle, and so as a result, we're going to collect that money, and this is how we're going to record the transaction. And by the way, the company that receives the $20 million, they can do whatever they want with the money. It's theirs, right? And that's the great thing about collecting money up front for things that you haven't provided. This is one reason why Warren Buffett loves the insurance industry. They collect money up front for things you haven't yet provided, and may never provide insurance, right? They hope you don't have a claim, right? And as you do not create claims, they move the liability out and they create a revenue. They debit the liability, credit revenue, and whatnot. And so that's a pretty good system. That's why the insurance industry is extremely profitable. Maybe not the health insurance industry these days, but certainly property and casualty, and definitely the life insurance business. So you kind of get the idea as to why that's a favored subject of his investment focus. And so, all right, so what goes on here with this transaction? So we collected $20 million up front. We deliver the product, and in this case, in the first year, because remember, we're at 1/4 is expired, so 1/4 of 20 million is $5 million. So we debit subscription revenue, okay, because it's no longer being it's no longer there, and we credit subscription revenue. So subscription revenue, and there are all kinds of account titles for the credit side of a firm that represents revenues or inflows. Interest revenue, sales revenue, subscription revenue, and the list goes on and on. But in this case, we've earned 1/4 of that for whatever reason. So we collected 20 million, and we delivered 1/4 of that. So as a result, we now recognize revenue. This is an important piece of what we call revenue recognition. We book the revenue as it's being earned, and as a result, the deferred liability goes down. In other words, we debit that, and that's the balance of the revenue account. Okay. All right, so that's when it comes to customer advances for all kinds of different reasons. Gift cards we talked about. There's a topic called breakage here, which I've heard a lot of different terms to this idea of people not returning or not redeeming gift cards. It's kind of a crazy thing, and there's been some academic work on this that I've sort of been looking at, where it talks about the fact that some sellers expect people not to be redeeming their gift cards. You get a gift card to, I don't know, Target or Bed Bath & Beyond, Bed Bath & Beyond, and you never bring it back. And so they're sort of building this in the expectation, and it's sort of a cynical view, but frankly, it's based upon research that shows that a lot of times people don't bring these back to redeem them. They forget about it, right? It's a gift card. I put it in the drawer somewhere, right? And again, if you're like me, I've got a whole stack. It looks like a deck of cards, right? So it's a later recognition of revenue. You're going to create a liability. Well, you're going to debit cash, create a liability, right? And there's some fees coming out of this because there are third-party vendors like retailers like Walgreens and Target and Walmart who sell these. And so it's not exactly a perfect, one debit, one credit. But nonetheless, the idea is ultimately you're going to debit the cash and a credit to a current liability. And maybe it comes back, but maybe it never does. And what if it's 10 years down the road? And companies have got to decide where the point of breakage is, where now we decide there's a remote possibility of redemption. Why? Because probably the person has lost it, right? That's probably what's going on. They were cleaning out the drawers, they threw it away, they didn't have any idea if it's worth anything, and as a result, it kind of goes away. This is a bigger number than what you might imagine, and it's Again, there's been some academic research on this as to how big this number is, but the idea is it's not small. Applebee's and all the companies that sell these gift cards, Chili's and Target, Walmart, it goes on and on. And Cracker Barrel, I mean, the list goes on and on. So breakage is the point at which the company says, hey, these cards are never going to come in. So we're going to recognize revenue, and we're simply going to say we're going to debit the current the liability. It's no longer really current at all, right? And sometimes you may move it down further on the balance sheet on the right side. And say it's a non-current liability, and there are estimates made as to that. But we're going to debit that, and we're going to credit revenue, and that's going to close out that portion of it that we think is no longer going to be collectible. And again, this goes back to one of the areas that we talk a lot about in intermediate accounting, where there are estimates that are made. Sometimes we don't always know exactly what's happening, but we make estimates. But the idea is, and this goes to professional practice and professional ethics, is it's going to be a good faith estimate of what's happening. We think that 20% of our gift cards are never going to be redeemed because they're 5 years or older. And I'd say after 5 years, it's probably a good bet they're never going to be redeemed. Maybe I'm wrong. I don't know. Maybe in my case, they're not wrong, but they're probably never going to be redeemed. So as a result, if it's a good faith estimate, if they're wrong, hopefully it's not that material of an event, frankly. How many of these people are going to dig up, from their couch or whatever, these gift cards? If they're wrong, well, then we have a way to treat it. We simply treat them as, as a sale, and we go from there. And it's no big deal. We simply go revenue and cash. There's no big deal. Debit, cash, credit, revenue. I mean, the original transaction, everything about it is already done. So it's going to be based on a good faith estimate. So let's talk about gift cards. So during May of 2021, Great Buy sold 2 million gift cards, and also during the month, 1.5 million were sold in prior periods, were redeemed, and 1 million gift cards sold in prior periods expired unused. Now, I think some gift cards do expire, a lot do not. And I don't frankly know what the policy of all the myriad retailers that offer these are, but sometimes they expire, sometimes they don't expire. I think the trend is to not expiring, but I think they think that, if you redeem it, you redeem it. It's not that big of a deal. It's probably not going to be material to anyone's results. So in this case, what is the transaction? During May, they collect 2 million in gift cards. That's people who buy gift cards to whatever Great Buy is, probably Best Buy or whatever, and they credit deferred revenue. Okay, deferred revenue obviously is a deferral. It's the event hasn't happened yet, so with any deferral, what are we deferring? We're deferring the activity, not the cash. The cash has already been collected. We're deferring the activity. So throughout that period, though, we also collect 1.5 million are redeemed. So we're going to book that into revenue because we've delivered the product. So we're going to credit revenue, and we're going to debit portion of this deferred revenue because there's still 500,000 outstanding. We're going to simply debit deferred revenue for 1.5 million. Okay, and that's how we handle that, and that's not particularly complicated. And it gets a little more challenging when we have franchisees who sort of forward this thing on. And this is something I frankly was not as sensitive to personally. I should have probably, until I sort of got into this issue of TGI Fridays. I was going through bankruptcy and what to do about franchisees, which really have no connection to the company whatsoever, except for the licensing agreements and whatnot. Operating activities are not joined, the balance sheets and income statements are not joined. But what do we do with gift cards? Are you going to redeem the gift cards? And so that was something that was really interesting, and it's probably one that I should probably earmark as a case study for future business courses. But you get the idea of what do we do with these liabilities that may or may not be redeemed, and it's a good question. So these are things we should be thinking about. Okay, and then the final one is there's 1 million, and that's been redeemed in gift card revenue, and we simply credit sales from there, sales or revenue, whatever you want to talk about. Okay, let's talk about any questions so far about anything. Anybody in the classroom? Okay. Okay. That's fine. Okay. All right. So let's talk about collections to third parties. So the most common examples that we could talk about here, but not the only, certainly, are things like collection based upon payroll. And these are things like withholding taxes. And we have an entire payroll force here that gets into this, and this, and this, and all these issues which deal with withholding from workers' pay. All right, and taxes are federal and state, sometimes local. We don't have a local tax here in New Mexico, but some states do. Where I come from, we have federal, state, and local tax, right? It's a county tax, actually. We don't have it here in New Mexico, but we have a fairly high sales tax. But we're not talking about sales tax here. We're talking about withholding, which is frankly a variation of withholding for third parties. But it's not the same context here because we're talking about taking taxes out of people's pay. So federal and state withholding, it's also things like workers' comp. It's things like unemployment benefits or unemployment tax. If states have an unemployment tax on workers, some states do not. Primarily in New Mexico, we tax businesses, not workers, for that. So that's not we allocate that differently. Businesses definitely have to withhold for federal unemployment tax. That's an issue as well. Social Security taxes, Social Security, and by the way, we should talk about Social Security / Medicare because there are two different things here, right? Social Security, we all, I think, know what it is. It's retirement pay for those who are reaching a certain age, and as a result, so it's paid by it's a joint tax paid by employer and employee. It's the same as Medicare in terms of joint tax. The amounts are different. 6.2% of employees pay up to some maximum is withheld in terms of Social Security taxes. That's paid by both the employer and employee. What's really interesting, it's an eye-opener as a business professor in talking to students, because I think a lot of people don't understand that businesses have got to pay not just the wage to the worker, but also Social Security tax and 6.2% of their pay. And then Medicare tax, which is 1.45% of their pay. Now, Social Security does cap out an amount, and it goes up every year with inflation. But these are additional amounts of compensation that have to be factored in when hiring an employee. And also include unemployment taxes, which have to be collected. This is a federal tax. And in some states, New Mexico being one of them, we have a workers' comp contribution, which is not that large in relation to things like Social Security and Medicare, but they nonetheless have to be collected, okay? And so these are amounts that employers have to pay. And for those of you who took Business 1180, we really get into this a lot. And it's sort of an eye-opener, I think, or at least I hope it is, to explain why sometimes employers are reluctant to hire workers, because it's not just the whatever it is, $80,000 salary we're going to pay you, or $50,000 or $100,000, whatever it is. We also have to pay Social Security, and unemployment, and Medicare, and workers' comp, and all these things, and things like our portion, the employer's portion of insurance, medical, dental, vision, and whatnot. So the amount of compensation is quite large. I know when I was doing my MBA quite a long time ago, I had a prof who was the HR director of a pretty big insurance company. And he said, look, we have a wage, $100,000 salary, we're going to multiply that by 40%, and it's only going to cost us $140,000 to employ that person, right? And that's been a while ago. It may be higher now, particularly because we have this great inflation in employee health costs. But nonetheless, these are areas where, from an accounting standpoint, we have to collect for third parties. And so we're going to create a liability, and we're going to sort of debit some of the compensation out, and we're going to pay it to third parties, whether it's the state government, local government, insurance companies, Medicare, Medicaid, all these kind of things are going to be I say Medicaid is actually, there's something called the Centers for Medicaid and Medicare, Centers for Medicare and Medicaid, which sort of handles the administrative aspect. But we're going to sort of forward these on to these respective entities, and we're going to do it on a timely basis, and we're going to do it because it's part of our natural function. Okay, so in this case, we have a sales tax, right? So, which is weird because we didn't talk about sales taxes here, right? We talked about mostly taxes on employees, but let's talk about sales tax. Okay, sales tax is a big issue, particularly for those jurisdictions which do not have an income tax. And there are a lot of states in this country that do not have an income tax. Texas, Florida, New Hampshire, I don't know about New Hampshire, Maine, I think. Texas, Florida, Maine, I think Washington State, I think Nevada does not have one. So, and in these cases, one of the big revenue generators is sales tax, and those sales taxes tend to be much higher. I know in Texas, I did a lot of work when I was in banking. I did some real estate financing in Texas, and they had a very high property tax relative to other places. I mean, the state's going to make up revenue, so they're going to get it somewhere. I mean, they can't print dollars, and so they're going to get it somewhere. And so, as a result, property taxes are one thing, but let's talk about sales taxes, or what in New Mexico we call it gross receipts taxes, and that is on goods and services. Some states do not charge sales taxes on services. That's kind of changing now because they've found that's as services are growing relative in strength and proportion to goods, it becomes an area that they should focus on. So certainly in New Mexico, what we have is called the gross receipts tax. If you get a haircut, which is a service, you're not walking out with a box of something in a sack. You're walking with a haircut, we charge you a gross receipts tax, right? And that's a tax that goes to the state of New Mexico. And sellers have to register with the state and say, okay, we will do business and we will forward you on the amount of tax that is due to you, the state, right? And so as a result, what do we have here, right? So we have cash as a debit for whatever it is, and we have a state and a local sales tax. Now, again, in New Mexico, we do not have a local sales tax. Sort of, we do. I mean, we kind of do, but we kind of don't, because every locality's got a different, and I don't want to get too complicated here, but every locality's got a different rate that they get from the state. So in this regard, we would sort of cut out some of that, and so as a result, some of it goes to the state, some of it doesn't. So in this case, $107. So a good costs $100. We charge 107. Sales revenue is the amount of the good we sell at the sales price, and we have sales tax payable of $7. And that goes off the state. The state does whatever it does with it. So in this regard, they divide it up between state and local or whatever, or they don't, whatever the case might be. And most states, I cannot think of a state that does not have a sales tax. There are a lot of states that do not have income taxes, but I can't think of states that do not have a sales tax. Florida is notorious for not having an income tax. It was a very high sales tax, and relative to some other places. And we have a relatively high sales tax here in New Mexico. I think in Bernalillo County it's 7.875 on goods that are taxed, and some goods are not taxed. And that's something that your software will deal with. If you're a retailer in particular, if you're selling aspirin or bread, it's not subject to sales tax. And so if you're selling shoes, yes, it will be subject. So it really depends upon the kind of good itself. Okay. All right. Quick quiz here. Advances from customers. Perkins Incorporated accepted an advance of $2,400 on December 1st, 2021 for providing IT help desk services. Perkins estimates fulfillment based on the passage of time. So one month into it, we have to do an adjusting entry to collect revenue. So we're assuming here, the assumption is probably pretty good. The year end is 12/31, December 31st. So it's a 6-month contract. So $2,400 divided 6 is $400 per month. So we would recognize what? $400, right? And that is the answer, right? So it's 1 month of that. The rest, the remaining 1,800, that simply become still current liabilities of unearned revenue as we go into the next year, 2022. Okay, so pretty simple. The math is not really intended here to be overly complex, but it does sort of lay out what some of the issues are. Okay. Okay, gift cards we talked about before. So Ling sold 30,000 gift cards during 2021. Also, 25,000 were redeemed, some which were sold in 2021. Now, I looked at this, I thought there's a lot going on here. This is a really long question, and it's not really that complicated. And you got things like some were redeemed, some weren't, some $2,500 of gift cards were sold, they may never be redeemed, whatever. And Ling finished the year with 17.5. A lot of this is not relevant. What we're really saying is they sold $30,000 of gift cards during 2021, and some of them were redeemed, right? And then some of them were redeemed from prior periods, right? And that's really all that we need to know. So we sold 30,000 of gift cards, but only 25,000 were redeemed. And then 2,500 were redeemed from a prior period. So as a result, 27,500. And that's all that remains. The rest goes to deferred revenue or current liability, right? we only recognize revenue in accrual accounting once the good or service has been delivered. And once it's been substantially delivered, then we sort of book it to revenue. Otherwise, it's in this case, it's a deferred revenue, it's a liability until that particular transaction has happened. Okay. All right. So any questions before we get into current versus non-current? And we are going to get into more about this. Remember, in chapter 13, we're sort of working our way down the balance sheet here. Those of you who are going to take 2130, intermediate 2, you'll get into other areas like the income statement cash flows in particular, and whatnot. But we're sort of working on the balance sheet here. And so we're going to talk about on these equities side of the balance sheet, the issue of current versus non-current classification and how we make that determination. So either an obligations, remember an obligation, and this is sort of maybe it's overly elementary for an intermediate accounting course, but it's stated at the outset of this chapter as being a probable obligation on the part of the company. In other words, it's a claim on assets of the company in the year or the operating cycle, whichever is longer. And so as a result, that's what current is. Okay. Sort of a textbook definition. And so we're going to report liabilities either current or non-current, right? And if it's non-current, it results in a higher working capital, higher current ratio. And what do we mean by that? All we're simply saying is, remember, current ratio is current assets over current liabilities. If we're moving a current liability down to a long-term liability, it's going to give us a higher current ratio, which is simply current assets divided by current liabilities. And a higher working capital because it's simply current assets minus current liabilities. And one is a division problem, one is a subtraction problem. But that's simply the case of reclassifying the liabilities either current versus non-current. Now, there are rules to how to do that. So I think it sort of makes it sound like we've got options here as to how to do it. But the key thing is if it's a long-term liability, we should recognize it as a long-term liability and not a current liability. Because the current liability has got to kind of go away, right? And if it doesn't go away, then maybe, in fact, it's not current in the first place. So it's a big issue. Let's talk about current liabilities first, because we're on this subject. And current liabilities are those which come due within the year or the operating cycle, whichever is long. We've talked about that. Well, we're going to transition now to long-term obligations, including things like bonds, notes, leases, which we're going to get to more in intermediate 2. Deferred tax liabilities, these are cases in which we sort of defer the obligation for however long, for whatever reason. By the way, we also have deferred tax assets, which we don't get into here. We get into in corporate tax accounting. That's just a different sort of benefit. One is a benefit, one is an asset, one's a liability. Here we're going to talk more about liabilities. And we're not really going to get into leases very much. And leases are sort of near and dear to my heart because it's a lot of years of my career in banking. I was involved in establishing leases for things as opposed to loan obligations. It was really a pretty great business. I really loved it a lot. And it's very interesting. And it's very good for customers. And so, it's a win-win. And I always like win-win scenarios. And so that's what's going on. So if we talk about here, the example, 20-year bond. So the rest of it, so if someone's due this year, then the rest of it's the 19 years of this obligation are going to be long-term, and then the 1 year is going to be a current maturity of long-term debt. CMLTD or CMTD, whatever you want to call it, is simply the amount that's payable that year, okay? And we're going to move it up as we do adjusting entries for the year end prior. We're going to say, okay, this is what's coming up for the next year. We're going to move the portion that's due of long-term debt into current liabilities because that's what it is, right? In other words, it's the current maturities of long-term debt. And it's not just bonds, it's a lot of notes payable, a lot of obligations, things like equipment notes, long-term financing of all different kinds. Some of it's going to be due. We're talking about the principal here, not the interest. The interest we reported is a debit to interest expense, but we're talking about the obligation that's sort of moving up from long-term liabilities into current liabilities because that amount's going to be paid in the current year. And so obviously, as we approach the end of an operating cycle, like a year end, we're going to sort of move that up because it's going to be payable. And so as a result, it becomes a current payable, a current liability. Okay. Excuse me, there's something in this room that makes me cough. I don't know what it is. So, all right. So we're talking about obligations callable by the creditor. So I don't know how common this is. This is debt that's callable, and then as if the creditor, which is primarily a bank, but it could be anybody, decides that the debt is going to be callable on demand, then we move it up to current liability, even if it's a long-term liability. It's really not very common, even though a lot of loan contracts, particularly bank loan contracts, have a call provision that says, okay, even things like car loans, and most people don't bother to read car loan contracts. You have a 5-year car loan, and if you're through a bank, some bank wherever, and there's probably some line item somewhere that says we're going to call, we can call this and have you pay us in full, and we'll give you a written notice or whatever. It's not common, especially in consumer transactions. But primarily, what we're dealing with here is business-to-business transactions. It's also not common there. I was in banking 19 years. I cannot imagine a time that we called a debt in early, unless they were in really bad shape. We wanted them to go away and find other financing or just pay us off and leave us, that sort of thing. I mean, I'm being kind of blunt here about the way it works. For the most part, it's not really that much of a thing, right? But the provision still exists, and so you can do it. And I think it's sort of an old school thing where back in the day when banks had a lot less liquidity, they sometimes had to call in debts, so they had more money to pay depositors and whatnot. We've not had that particular problem in the U.S. for a very, very long time. Banks have all kinds of access to capital, even in the financial crisis, 2008. In this case, they have a sort of a government lifeline, but that was a little bit unusual. But beyond that, except for that, it's not really a thing. So callable debt. If you come across callable debt, and I want to know about it, somebody should send me an email because I never saw it happen. I always saw it written into contracts, but I never, ever saw it happen, except in the case of a borrower that we really wanted to go away. So think about that, and that's. But if it does happen, you move into current liabilities because it could be taken away. All right. What about debt that's expected to be refinanced? And so if the company intends to refinance debt, that's a long-term debt, and they actually demonstrated the ability to do that, then we simply reflect it as such, right? So some long-term debt is considered non-current, and if it's long-term, maybe it goes to short-term, maybe it doesn't, but there's some sort of evidence as to what we're going to do with that. So remember, we're talking about from the accounting standpoint of the firm itself. We're not talking about the lender standpoint here. We're talking about the standpoint of the obligor, the borrower in this case, right? Okay, so we can classify as non-current as pushing down the long-term liabilities, which we would do. Why? Well, maybe it helps our current ratio. And by the way, when we talk about these ratios, it makes it sound like it's just some sort of academic exercise, but a lot of loan covenants are based upon the idea that borrowing firms have got to maintain certain ratios, right? Whether it's current ratio, working capital, which is a dollar figure, things like return on equity and whatnot. And so these are not insignificant because these are part of the loan agreement itself. And so sometimes it makes sense to sort of move assets down to long-term liabilities as opposed to current liabilities, because it makes the company look more liquid. That is the idea of having more assets to pay short-term obligations. Okay, and you can read this for yourself. This is kind of a long thing here, but Brown Brothers Ice Cream had 12 million of notes payable and mature in May 2022. Also had 4 million of bonds issued in 1992. Excuse me, they mature in February of this coming year, and December 31st of 2021, which is the end of the year prior, the company's fiscal year end. All right, so it's 12/31 year end. Management intended to refinance both on a long-term basis. Okay, so this is not uncommon at all. And I know this is lengthy. I know it's long, but I do want to talk about it because this is not uncommon at all, where companies have long-term debt and they don't just pay it off when it matures. Sometimes they just refinance it. And if it's in the form of bonds, they do what's called refunding. And this goes on and on and on. And by the way, if companies get bigger and bigger and bigger over time, that amount of debt looks smaller and smaller and smaller as a proportion of it. So why not refinance it, particularly if the interest rate is well manageable and you can maintain the advantage of the debt. So this is something that I think we don't talk enough about in accounting, and but we do in finance, I think. is the idea that debt can be very beneficial to a company, particularly because it provides long-term financing, support for assets, and at a very low cost, particularly over long time periods. And you can outgrow the debt, right? You can outgrow the debt over time, and so the debt is not that big of a deal, presuming you're growing, and assuming you can pay the debt off. So on February 7th, the company issued 4 million 20-year bonds. That's 4 million to refinance these guys here, right? And applying the proceeds of refinance. And in early March, which is before the May 12 million, they're going to do a line of credit for up to 7 million at any time. And so as a result, some of this is going to be refinanced. Now, the interest of the London interbank borrowing rate, I think that is now gone. The one called the LIBOR, London Interbank Offered Rate, I think that's no longer a thing. I think the British government shut that down because of some corruption in that area. So the textbook is a little bit outdated here. There is another rate that we potentially use called the SOFR, this Secured Overnight Financing Rate. So, but let's just kind of go with the example that's given here. It's a little bit outdated, but and the LIBOR is simply a rate that was used to tie to a lot of financing and whatnot. So in this regard, what do we got? All right, so the 4 million is going to get refinanced, okay? And oops, let me see what I do. Oh shoot, what did I just do here? So, okay, here we go. All right, so we have notes payable. All right, so the 4 million that's going to be refinanced is simply going to go in long-term liabilities. And then the 5 of the 12 million is going to go into current liabilities, notes payable. Presumably, the firm intends to pay that off in that current period. The 7 million on the line of credit is in notes payable. Lines of credit are a little bit tricky. I'm a little bit skeptical about the idea of putting it as a long-term liability, but I get the idea, particularly if it's a long-term obligation, maybe, but it's simply a refinance. The key point is we have this amount of debt. We have 16 million of debt, and what do we do with it as they're coming due in this particular year, right? Well, this we know is going to be easy. We're simply going to restructure, refinance, whatever the case might be, right? The notes payable is simply going to be a different credit facility for that, and the other we're just simply going to move up because it's due, right? Now, there's nothing to suggest that the company cannot move this down later if they want to, if they're able to. Maybe they don't want to. Maybe they intend to pay that $5 million off. Who knows what the case might be, but it really deals with the management intent and what the management plans to do with that financing. Okay. All right, so that's essentially what's at work there. Okay, and then we're going to do a bit of a comparison between the GAAP standards and international standards, and there are some differences. Obviously, I underline the fact that if refinancing is completed for the issuance of financial statements, then we can classify those as long-term liabilities and not short-term liabilities. Why? Because make our liquidity and all that look better. And so on the IFRS standards, it's going to be done before the balance sheet date. So if you have a December 31st year end, which I think was the example we had earlier, and then a couple of months afterwards in the GAAP standards, as long as you know before the statements are done and issued, which is several weeks after the year end, then you can go ahead and book that as and classify it as long-term liabilities. But here, it's got to already be done. So the international standards are way more conservative in a lot of ways. Maybe not way more, but certainly more conservative. And I think it's not wrong. I've never really been critical at all about those standards. Okay, we got about 4 minutes, so let's talk about non-current bonds. We're going to talk more about bonds and what they're about. They're long-term liabilities issued in public markets primarily. Not always, but usually. And so Kim's Academy of 10 million X bonds payable and due in 2022. Prior to 12/31 of 2021, Kim refinanced 3 million of the X bonds with other bonds that mature in 2032, which means they're going to move down into long-term liabilities. On January 15th of 2022, Kim refinanced another 2 million of the X bonds with those that mature in 2029. And the statements were issued on February 1st, okay? February 1st, remember this. On February 15th, they refinanced another 4 million. All right, so we're assuming this is based on the GAAP standards, okay? So they refinanced what? They refinanced 3 million and then 2 million, right? And the 4 million, the 4 million came after the fact. So as a result, it's only 5 million that moves to non-current because it was done after the statement prep was done. So again, GAAP standards are a little bit more loosey-goosey in terms of what accountants can do. And there's no question that managers will take advantage of these particular opportunities to move things. And, I've heard many times, talked to a lot of CEOs and CFOs who said that we're about balance sheet management, right? And we're trying to make our balance sheet look good and our income statement look good, right? If the balance sheet looks good, everything else kind of is secondary to that. So, and that's an important consideration here as to what's going on in terms of balance sheet management. In other words, non-current bonds. Okay. And then one final thing, we're almost out of time, and I think I want to sort of stop here and talk about, because we only have 2 minutes, and I have to leave the room here. I want to stop here and talk about contingencies. It's an interesting topic. It's going to take a little bit more than what I've got here, and I know that we're short on time, but that's sort of the nature of the beast in intermediate accounting. We're always short on time. We could do this 24/7, I suppose. But I'm going to stop here, and we come back. I'm going to do a supplementary video talking about contingencies and everything else in chapter 13. Sort of what's remaining. And when we talk about contingencies, we're talking about things which may happen or may not happen, but we're going to sort of estimate, what the odds are, and we're going to create liabilities as a result of that. So I will pick that up probably tomorrow, I would guess. And because they're in class the rest of the day, but we'll get to that and go from there. But in the meantime, if you have questions about anything, I'm in town all week. I'm not leaving town for the holidays. I'm not leaving town until after Christmas, and so feel free to get with me. I'm here Monday through Saturday, really, and feel free to reach out. I'm more than glad to help you with any questions you have. And if I don't speak to you before then, have a nice Thanksgiving with you and your family, and I will see you all next time.